I would maybe speak about GIDE first. We are a leading French law firm with a very strong focus in the real estate industry. We are in Paris somehow maybe 100 practitioners being active in the industry, among which 40 people strictly dedicated to the real estate sector. We are 9 partners in Paris. I'm one of those 9 partners. I used to be based here in London to address the investors based in London who are actually active or interested in the French market. I'm now based in Paris, but I split my time between London and Paris offices. In short, that's what we can say.
Great. Paul?
I'm the president of General Continental Investments. The company was formed in 1975, and it is specialized in, concentrated on offices, and over the years it's done about 1.7 million square meters and 2.5 billion euros. So we take letting risk. We either do renovations in central Paris or around Paris, La Défense, Saint-Denis, and so on. The company is partly a family company, and we think that now is an excellent time for the French market, which I'll go into a little later.
Great, thank you, Paul. Andrew?
Good morning, Angeli, Head of Strategy and Research for CBRE Global Investors. CBRE GI is the fund manager related to the US listed services organization. Within Europe, Europe is our largest region in terms of assets under management, with around 50 billion US dollars. And within that, France is important to us and of growing importance. We've been successful bringing clients from various risk-return hurdle perspectives to the market, and we look forward to doing more of that over the near term.
Great. Serge?
Serge Bacconnier. So I joined Berlin-IP 2.5 years ago, coming from a French bank. I came to support the development of the Paris office on the French market. Berlin-IP is one of the top mortgage lending banks in Germany, benefiting from the Pfandbrief tool, which enables to give some good pricings on core assets, typically. We have been present in Paris for a long time, and we are aiming to develop and increase our presence, mainly in Paris and eventually in some regions. Berlin-IP as a whole has a 20 billion mortgage loan book, and with 600 people working there. In Paris, we are a team of 4, and in terms of coverage of the European scene, we also have teams in the Netherlands, covering the Benelux, and in Poland, in Warsaw, covering Poland and Czech Republic. I think we can say that Berlin-IP has very much evolved in the last years, becoming more innovative and typically with a big focus on green assets, financing green assets. And we have issued the first green bond in Germany, and we are aiming at increasing the share of green assets in our portfolio.
Great. Guillaume?
Hi, my name is Guillaume. I run FARO Capital, which is a real estate boutique firm investment, mainly draining French institutional family office money in the value-add space, mainly Western Europe, with a specific focus on France, Paris. So here I am.
Great, thank you. Maybe let's start with you, Paul. Just in terms of the market, what's the sort of biggest changes that you've seen in the past 12 months?
Well, I think we've seen a continuation of the hardening of rents. The rents are moving in certain areas. And we've seen also no movement in the yields going up. If anything, there's been some slight movement in yields going down. Paris, after all, is, I understand, the 3rd biggest market in the world, capital city. And the what can I tell you? I think from 1987 to 91, rents went up by 70% there. from 97 to 2002 by 70%. And we know in Europe, even London, the rents went up by nearly 100% several years ago. But in Paris, since about 2002, rents have been static. And they started to move in central Paris, a couple of years ago, and that is continuing today. The market in Paris itself is very strong, and its rents are going up. There's a limited number of buildings. The other thing is that there's also happening Grand Paris at the same time, which will have a major effect.
Okay, good. We'll pick up Grand Paris in a minute. Andrew, it'd be good just to get your perspective, because obviously CBRE Global Investors investing across the globe. You're looking at Pan-Europe especially. So how do you see France at the moment within that perspective, and has that changed over the past 12 months?
Yeah, absolutely. I think the biggest change from my perspective is the sentiment change over the last, say, 12 to 18 months from European investors, global investors as well. When you look at the G7 economies right now, France is maybe somewhat surprisingly to many outside observers one of the best performing G7 economies currently, and that outlook is pretty favorable over the near term. And that outlook is stable. And in a world where we have heightened global uncertainty stemming from U.S. and Chinese relations, a slowdown in Germany, Brexit, the litany of other examples, there's something comforting, something attractive to a stable economic outlook. And so I think that's certainly one of the reasons why you've seen new entrants to the market, like Tom showed. And against that backdrop, you have very favorable fundamentals in the Paris office market. With vacancy, exceptionally low, grade A vacancy, effectively non-existent. That is the recipe for rental growth, and I think that again explains the confidence that investors have of committing to forward purchases, to taking on speculative risk, because you can be pretty darn certain that you're going to let that building up pretty quickly at rents higher than the market is currently achieving. At least that's been our experience.
Hugues, it's quite interesting to see how these discussions change over a while. I mean, it's not so long ago that we were having a discussion in Paris around this, and it was dominated by political risk and the Gilets jaunes, and would that completely undermine everything that Macron was trying to achieve, and the poor effect on investor sentiment. And then here we are looking at investor sentiment being very positive, stable economy, that being a big positive. Is all the sort of Gilets jaunes stuff now over? Is that kind of gone, or is that just background noise? What's your sense of that?
Well, whether it's over or not is hard to say, of course. I think we have still big challenges to tackle in the near future, including the fact that we will have local elections and in early 2020 that may, drive some people to, take this opportunity to claim for more reforms and more advantages from the new Macron regime. So whether it's over, probably not. Whether it has a genuine impact on our market, I think clearly no. And what has been said, so far this morning proves it. I think the fundamentals are very strong. The tenancy market is good. The take-up has been, at a record, very high level. The capital capital flow is very high as well, combining the local players who have been very strong historically, including, due to the fact that we have very strong retail fund managers locally who attract a lot of capital, combined with the new attractivity of the Paris market for investors such as the South Koreans, as mentioned rightfully by Tom. So I think given the fundamentals, I think except if, Gilets jaunes or any other demonstrations or massive trends like this, which nobody can suspect now, impact those fundamentals. I think we are on the right way. And we will have a record year, I think, by size in terms of both volumes and number of transactions. There is still a big flow of transactions coming in for the next weeks. I think the brokers are all very busy. We have also some sort of an external impact due to the tax reform that will come into place on the 1st of January, leading some players to divest their assets or bringing some volume to the market. So I don't see why the trend would stop.
Okay, good. Look, I'll come back to that tax reform thing in a minute, actually. And Serge, obviously, you're having to presumably get all the French deals put through the committees in Germany. Has there been a change in perception in terms of, from that side, in terms of the French market?
I think I totally agree with all what has been just said. What is important for us in the current environment, when we see the monetary policy keeping the rates at a very low level and yields being very low, for us as a bank, the good thing is that there is capital inflows and newcomers, as mentioned by Tom, namely from the Koreans and Asian. In this very low yield environment, what is critical for us is the refinancing and the maturity of our loans. We have loans at 7 to 10 years, sometimes even longer. So what is important for us is to keep loans with a reasonable LTV, and sometimes we also look at debt per square foot in order to maintain a stable outlook into the future. So I think the good aspect on the market, and where we keep confident on having clients satisfied, is that the LTV levels have remained in a certain conservative level. So we are pretty comfortable to see our loans being refinanced at maturity.
Okay, good. And Guillaume, you're obviously representing different types of capital in a way. What's driving the interest in the Paris market, especially the French market, for them?
Well, for answer one is like easy. It's Paris, as mentioned by Paul, is a global hub. So it's if you want to be present internationally, it's hard to avoid Paris, basically. Second is from I would say family office perspective, Paris has that kind of special flavor, all the gastronomy, fashion, and stuff like this. So obviously, it helps. And I would say the momentum, well, from a family office perspective, doesn't really help because, as mentioned, a lot of capital is chasing, a lot of products, and basically the space where those guys were acting, mainly, I would say, small, medium tickets, notably in the value-add space, are being also chased by the, big capital raisers, such as, the big names in the US or in the UK. So the market in terms of competition is, emulation is good, obviously, but, here the competition is beginning to be fierce, and even if we have maybe, small, I would say, yields appreciation in the short term, notably thanks to the announcement of the Fed of the ECB, and obviously, Rennes is definitely moving the right way from a London perspective. I would suspect that the next competition chasing, I would say, medium small asset size in search for value creation will potentially create a long queue in Paris. So the game is a little bit changing also on that aspect too.
Okay, good. And Paul, you mentioned there, and Tom obviously did the Grand Paris infrastructure, and you also mentioned in your introduction that you were developing in Paris and also Saint-Denis, which was picked up also as an area by Tom. How much of an influence do you think Grand Paris is going to have, that project and the Olympics? And there was also a mention of that there's very limited product at the moment. So does that mean that now is the time to develop? What's your sense of that?
Well, I think that the Grand Paris is something very unique. Personally, I think it's based on the fact that I think today there's a tendency for young people they want to work in the city centre and live there as well. And there's been a problem in Paris since the Second World War ended, is they have not allowed any towers to be built within the city centre. except for one that got through, actually. So that means that a lot of the people, and younger people, they live outside Paris. So the idea of Grand Paris, they're building 68 metro stations, is obviously going to have, and is having, a major effect on the market. That means that people who are not building towers, will be living outside, will be able to come in, in 20 minutes and go out instead of 1.5 hours. So that will have a major effect, and on different areas. There'll be new areas created, which are beginning to be created, and yeah. So it's actually president of one of the major investors said to me, this happens once every 250 years. So I think it's very special and very positive. And that means there's a lot of construction going on around Paris, not only for developments, but also for the new metro lines and roads being linking to that. So there's a lot of that going on. So I think it will have a major effect. I think it'll be finished. The idea will be finished by 2030, and certainly the Grand Paris related to the Olympic Games will be obviously finished by 2024 when the Olympics are, and that is happening in Saint-Denis. That's where the Olympic Village will be. That's where the Grand Stadium is, and it's already changing values. You take that as an example. Saint-Denis. Saint-Denis is located on the RER lines, which is very positive, but there's certain areas of Saint-Denis just on the metro lines, and they're not very good actually. Now you take in 2024, there will be new metros going there, and from south to north, for example, and it's going to have a major effect, and that'll be done by anything related to the Olympic Games obviously will be done by 2024.
Okay, good. And Andrew, in terms of you mentioned there that you were very positive about France and Paris. How much of that is related to this idea of potential increase in rent? I thought that was interesting. Paul's look back at the history of that, where the London market rents had increased, but they've been static in Paris, so there's maybe an opportunity for a catch-up there. How much of it is based on that, and how much of it is based on the sort of momentum of things like Grand Paris creating different areas?
I think it's just a great story for Paris at the moment, with the Olympics coming up, with a demonstrated ability to invest and commit to a long-term infrastructure project. That's a preferred strategy for us globally. We like piggybacking off of the success of infrastructure investments. We have insurance clients, pension fund clients who are, reliably long-term investors. And when you can take a 10, 15 plus year view with your hold period, it provides a lot of comfort knowing that this transformational infrastructure project will ultimately be delivered. The rental growth story is certainly nuanced. I think that what we've seen, and again, one of our recommended strategies to our investors is really targeting fringe CBD areas where the catch-up growth potential is the greatest. Rents in absolute terms in Paris are incredibly high because of the growth that we've seen over the years, and in some ways is pushing out some of the creative industries or startup industries who just can't commit that type of rent to be in that strategic of a location. But there are locations. The 11th arrondissement in particular is one that we've recently had success in, where I think the scope for rental growth, the scope for catch-up growth is incredibly pronounced. And again, if you have a medium-term business plan and can be patient to capture that reversion, I think you'll be rewarded for that.
Okay, good. I've just got a question come in, so thank you for that. And by the way, if you see questions come in and you like them, you can also like them, and then they'll go higher up on my list, just to let you know. Which is positive momentum around the Paris region at the moment, but what could go wrong in the next 12 months? So I can see it's somebody who's got a half glass. So what could go wrong? Oversupply, yields? What are the sort of potential downturns, or is it all sunshine?
I think you have to be a little careful about that, because what we've been seeing in Paris over the last 3 years, when rents in central Paris started to move a bit, is it's difficult to generalize on the whole market. We know, for example, in the last 18 months, for various reasons, the south of Paris has been a very strong market. There are other areas, like the east, which have also been strong. La Défense has quite a lot of vacancy today, but in my view that will certainly change. La Défense always comes back and wins. Saint-Denis, we have what do you call it? A VEFA.
Forward sale.
What?
Forward purchase, forward sale, forward commitment.
Right. And we let about 25,000 square meters. We let 60% of it. And people, that's in the north. So that's been a little weak, but it'll change. So it's difficult to generalize on one moment on the total market. There are parts of the market going up, part of the market staying where they are. So you have to be a little bit careful listening to them.
Okay, good. I'm going to come to, we can go into a bit more detail into some of the sectors and also the locations. I just wanted to pick up one point from Tom's presentation there about the capital and the range of capital. Very interesting to see that sudden leap in South Korean capital. Serge, maybe from your point of view, because you've obviously got people coming to you, what are you seeing in terms of the change of the types of capital? Are you seeing, as well as South Koreans, are you seeing a larger number of sort of investors looking?
Yeah, maybe coming back to the Grand Paris, just one point is effectively it creates a great momentum. And for us, it's a good opportunity to develop our business, because I think we had a model where we were initially more concentrated on CBD transaction because of the fund brief and the cash flow. We were looking at assets with cash flow in very secured areas. The good thing with the Grand Paris is that it creates a momentum, and for us, looking at transactions with good connectivity, I think that's really the key, because it can be possible to look at other assets in the first and second rim, but as long as the connectivity is good, I think we have a play, and it's good to have a larger, deeper market, which obviously is already the case for Paris CBD, but it's expanding, and it's good for the market as a whole in Paris. On the flow of capital, indeed, in the last year we have seen a number of transactions where Asian capital was at play. I think one of the biggest challenges for us when we have done some deals with Korean investors, it's very important for us as a bank to make sure that for investors coming from this region to have local asset managers. Which is not always the case. So we need to have the comfort of having a local presence to manage the asset and to make the link with eventually another asset manager working for the investors in Korea. It's as mentioned by Tom in the presentation, it gives a lot of capital inflow and creates, in terms of pricing, maybe higher prices, on which we remain very careful. So we have not been able to look at all the transactions for these Korean investors.
I think it's worth mentioning that most of the Koreans, if not all, are actually backed by local asset or fund managers who have a very long-standing presence and knowledge of the market, such as Primonial, Amundi, La Française, Heinz. Those players have been backing those transactions for a quite big variety of different investors, as presented by Tom. Just coming back to the possible areas for vigilance going forward, maybe the take-up, figures are a bit, they have to be understood as they are, in the sense that the market has been sustained mostly by co-workers, and the co-working business is still, raising some questions as a whole. So that could be a question going forward, because they've been taking very large buildings in the Paris market, also by law firms actually in Paris, and I think most of them have actually changed, have actually moved. So whether there is still some area for new movings from that part of the market is a question mark. Also a couple of transfers due to Brexit, such as Bank of America, such as HSBC. Whether we'll have in the take-up additional players coming to Paris due to Brexit is also a question mark. So I'm not saying at all that the market is questionable, but just to say that it has to be looked at carefully, depending on what kind of sectors are actually taking those new buildings, especially in the central Paris. I think it's maybe less, probably different in Saint-Denis, in La Défense and so on, but in the CBD, maybe there is less room going forward for moves as large as the ones we've seen in the last 2-3 years.
Okay, good. Guillaume, just in terms of that capital, you mentioned the amount of capital, and obviously Blackstone just raised 20 billion. Is your sense that there's so much capital around at the moment that actually that's going to be, and it's got to come to Paris, a certain amount of it, so that's creating that, and maybe driving some of your investors to other markets?
Yeah, obviously, as I was mentioning before, Paris has to be a stop by for those guys. But the large fund who raised like tremendous amount of capital are more looking now at platforms buying or larger schemes, and obviously they can spend time. Even the 100 million, 200 million, usual acquisition for them is just, if you have to place like 20 billion plus the debt on it in like 1 year or 2 years time, you can't buy like 200 assets or something. So obviously those guys are concentrating on other strategies. And well, as mentioned in the slide, there's I would say the alternative sector is pretty weak in France, obviously, due to the lack of, I would say, large platform operators. But I'm sure a lot of capital is now strengthening or building those kinds of platforms just to dig into this real estate. As obviously, you can't go buy an office as you would be managing healthcare or senior housing. You need people on the ground and a real team to take care of that. Maybe also is I would say that because there's so many points to pick up on, and it's this is what real estate is about. So many discussions. Maybe just for we've seen like a lot of different type of capital. So I would say the large fundraiser will be more digging into, as I was explaining, more into companies buying. Koreans, it's no offense to their strategy, but it's they're doing real estate because as of now in terms of allocation, it's great for them. It's not about real estate; it's just about the cash and they can get and the asset plus the hedging plus the financing they can put on the top of it. So as of today, it's Paris, it's real estate. Maybe tomorrow it will be Ireland or Holland or Austria or whatever. So I think it's kind of waves also coming to Paris in relation to the allocation to the strategy. But for sure, for the I would say the mid-sized guys and the small-sized guys, it's going to be especially if you're whatever you're looking for, core plus or value add, it's you're going to struggle for the product. And I think the next year winner is going to be the one who is I would say better equipped with with the best partner who can address the most interesting products, who can really do what the brokers used to do when I started like 20 years ago, when those guys were street business guys where they were looking for the products. And as of now, we got to do what real estate was about a long time ago. So looking for the products and then adding all the partnership on the top of that.
I'm going to pick up some questions from you, which is great. How confident are you in the fact that the infrastructure and real estate development for the Olympics, so especially around Saint-Denis, is sustainable post 2024? Who would like to pick that up? Guillaume?
Well, I'm not so positive about the Grand Paris is great, and obviously it's going to link, I would say, the suburban cities in between, which and the usual as of now, you have to go back to the center of Paris if you want to go to the other side of Paris. So it's kind of crazy, but it's how it works. In relation to the Olympics, it's first, I would say it's a very narrow kind of environment. And when you look at post-Olympics kind of stuff, no offense to London, obviously, but I went with I teach at university, and we went with the students at Stratford, where the London Olympics were, and the reconversion of that is, it's beautiful, I like it, but there's no life, it's not really working as those guys would imagine it could, be reversed after. So I would suspect that it will be improved definitely, because as mentioned by Paul, when you look at Saint-Denis 5 to 10 years ago, it was, no offense to that, but a little bit crappy, and now it's getting way better. I think the Olympics is going to improve, but I don't suspect that the Olympics is going to catalyze or going to overblow. Saint-Denis will remain Saint-Denis, good hubs close to obviously regional train on the metro lines, but there will be still, I would say, a little flavor of what Saint-Denis has always been. So suburban and maybe not so T1 as an office or resi market.
Can I pick up on that one? I think
anybody can pick up on anything.
Great.
Just to permission you.
Maybe take a bit more constructive approach there. I mean, clearly there's no shortage of horror stories of failed Olympic projects going through after the Olympics. Montreal, Athens, Barcelona, right? I think that
Brazil.
We could. It's a long host, but I think what London did was really catalyze the Stratford area, and we can debate about the quality of the residential accommodation, but look at Westfield, look at the transport infrastructure, the investment, and how that area has rapidly transformed with traditional city occupiers moving out there, the FCA, great example. And I think that creates a positive competitive tension for Paris, looking at the London experience and saying, well, we want to do that and be better. And I think in the area of Saint-Denis in particular, as was mentioned, there's actually a lot of scope to improve that micro environment. So maybe you are indeed starting from a low base, which actually suggests a potentially bright future for that area.
I think as far as Saint-Denis is concerned, you have to remember Saint-Denis is the second largest market, after La Défense, in the Paris region. And it's a good market, it's close to Paris, and over the last 15 years or so, it's been very successful. The Grand Paris and Saint-Denis will evolve with the Olympics, because there's a new metro line south to north. I've forgotten it,
14.
Number 14, that's right. And will come out as another area in Saint-Denis, and the result basically very close to where they're building the Olympic Village, and that will have a major effect. It'll be completed obviously before 2024, and that's going to have a major effect on the market in Saint-Denis. At the moment, Pleyel, which is that area, is not very well thought of, but when the Olympics come in and that metro is there, then there'll be a very strong development area which will add value to Saint-Denis. And once it's done, the same as in London, once it's done, it'll stay. I mean, these are new buildings.
Needless to say that the main benefit of the Olympics, very short term, is to actually speed up the completion of those infrastructure projects, which may have taken probably twice the time without the Olympic Games, plus direct some public funds to those projects. I think it's clear.
Yeah, I think there's nothing to say about the location and the connectivity. Maybe the one issue is how they are able to convert these assets after the Olympics.
Okay, good. There's a couple of questions coming on the alternative side and the residential part of it, which you also picked up there, Tom. We also did a session actually on kind of cradle to grave investment in Paris last week, which is interesting about the senior living side there, which seems to be developing quite rapidly. Are there the question that came in is, are there any cultural or political constraints to the institutionalization of the alternative sector, of that sort of residential, senior living, healthcare, those kinds of things? Anybody can pick that up.
Well, clearly, the institutional players have gone away from the residential sector for like last 15 years, due to plenty of reasons. But the legal regime that applies to tenants, to residential tenants, is not, let's make it this way, very favorable to landlords. So the only way to attract capital to that class of assets is probably to have big platforms, as Guillaume said. There are not so many for the time being, even though some players are working on that and trying to build more attractive platforms. Without the size effect, you cannot really tackle the risk deriving from that legal regime, which is not that protective for landlords. We had that large transaction a year ago, and at GIDE we've been active for the purchaser, so we know very well that transaction. It is a very specific one, because the transaction is backed by the state, to make it simple, as the occupiers are the railway national company staff. And I'm not sure that we can duplicate that kind of transactions, especially of that size, easily, due to what I've just mentioned. I think we will have another or a couple of other similar transactions coming in the coming month. It's not public yet, but there are some in the pipe. But I don't think we can take it as a general, I would say, trend for the residential sector, except if the legislation changes. You need volume, you need size, and you need operators truly dedicated to managing those units, which are very time consuming and so on. So yes, it's a class of asset that needs capital. We have a very high demand for resi, but I think the market is not well structured enough for the time being to attract more capital than what we see now. I don't know what you think, but
yeah, maybe just to pick up on that, because it's exactly the summary you did is exactly this. It's the regulation is crazy and it's changing. Even we have a 5-year president, but even during the presidency it can change. So the view on that is like so narrow. It's really hard to have a proper forecast. And as you mentioned, a lot of people would be happy to do resi if obviously the regulation was, I would say, not so roller coaster. But there's basically nothing on the market. So the resi that is owned from a large perspective is mainly owned by public or half public kind of institutions. So you don't want to put your finger into that because it's kind of tricky. Additionally to that, we have the wave of social housing imposed when you're building some new stuff, 25%. You have also the rent threshold now from the large cities where the rent have been really high. So when you mix all of this, obviously, no depth, regulation changing, I would say half public actors plus, a view, I would say, from the population, which is not so good in relation to resi. It's way better to do, I would say, easy commercial real estate rather than just taking high risk and potentially, not getting your fingers out of it.
Okay,
And
good.
maybe as to add up is as it remains a niche market and a market that is less organized and developed, it's also more difficult for banks to finance this type of projects. So I guess it doesn't help also investors going on this.
Okay, so that's a limiting factor at the moment in the market. Now, we're going to move on to a relatively quick fire session here so that then we can get a number of things in just quickly before we have coffee. Just one thing I wanted to pick up was obviously a huge amount of the investment goes into Paris, but what about regional cities? What about Lyon? What about the other cities? Where are the opportunities there? Is that something that's potentially interesting, Paul?
Yes, although I think there is a difference. I come back to it, but Paris is a major capital city. It's not like, I'm not saying which one is better. I'm not saying like in Germany where they have, Hamburg, Frankfurt, Munich and so on. So you don't know, Paris is the major city. I think there are some regional areas which I think are very attractive. We particularly like Lyon, which is and done a few schemes there. And Lyon, which is only a 2-hour train ride, metro line from Paris. It's a great city, and there's often the rents are much lower, and there's a strong demand. And there are other, regional cities which are, attractive, but I don't know whether in Toulouse or whether, but we ourselves, we tend to stick to Paris. Because most of these cities are a lot smaller, obviously, and there can be quite a lot of politics involved. That's what you don't get in Paris. That's one of the reasons for doing it. But yeah, I think especially over the last year, there's been increasing investment in some provincial cities. Yeah.
Okay, good. Did you want to pick that up?
Yeah, if I can pick up on Lyon in particular, definitely share the enthusiasm for that market. I do like to toot my own horn on this one in terms of calling the market from a rental growth perspective. I always have to remind my internal colleagues that we've called it right and it's continuing to perform. This is actually across property sectors as well. It's office, it's retail, it's logistics, and actually the resi story there is arguably maybe a little bit more interesting than in Paris. The growth story in Lyon is actually stronger than Paris. A really diverse industrial mix, which is attractive to us. A strategic location with linkages into Italy. So all that's positive. You saw on Tom's chart earlier that liquidity has improved in Lyon over the last couple of years. So that should engender some confidence. I guess the caveat is that it's a very it's dominated by French institutions, so gaining traction in the market and certainly securing the types of product that we would like to buy for our investors, that's been the real challenge. So maybe that speaks to forward funding, which we did a forward funding of a cross-dock facility in Lyon as an example. But offices certainly have been trickier to unlock.
Okay, good. And just as a quick gallop through the sectors, retail, anybody looking at retail?
Yeah.
Yeah, okay, good.
Well, retail is not on the scope of a lot of people, but if you take apart, obviously, the large mall, which are dominated by the big players, and it's way out of basically our league here, obviously. But if you look at the retail park sector, or obviously the high street, it's doing still pretty good. Obviously, the I would say tier 2 city mall or central mall are really suffering. And I was discussing with one of person in the room of that. And there is some, if you really cherry pick, and if you have obviously the brave and a really good partner, you can do something that is that can be interesting. Obviously, you're picking this at a very silly price, but at the end is building something that is strong, and just to be sure that you can obviously exit that with I would say a proper next owner. But it's once again it's a very granular kind of investment. That obviously, if you have a large amount of capital, you won't be like buying like the $200 in the tier 2, 3, 4 cities in France. But I think for retail parks and obviously luxury high-end in a central location, it's there's still a good way going on. Yeah.
Okay, good. I've got a quick question here, just on the tax reform and the possible impact on investment volumes. Do you see anything there? You mentioned that investment will
No,
be
the one I was mentioning earlier is due to the new tax treaty between Luxembourg and France. It has been enacted a year ago, and basically it changes the rules as concerning the capital gain over divestment of real estate held through PCIs. PCI is a French private held real estate fund, non-listed one, which is tax exempt until the end of this year. When you were owning an PCI through a Lux entity, the capital gain was taxed at a 5% withholding tax, and that 5% will turn into 30%. There are some possibilities to reduce that to 15%. But it's a big change in the game, leading some players to divest some of their assets by year end. So it's also one of the reasons why there is high volume this year, for those players to benefit from that reduced withholding tax rate by year end.
Okay, good. And the last couple of ones here. Just picking up on the office sector particularly, do you think that the future office supply may impact rents? And also, just in terms of yields, do we think there's a potential for yields to fall further?
So on the rents, this is quite fresh. We just finalized our biannual forecasting process, and I think can't paint the Paris office market with one broad brush. We do see weakness in La Défense and the Western Crescent near term. That's a speculative supply point for La Défense, and it's an existing high vacancy rate in Western Crescent. I would say that the difference in our forecasts for Paris by submarket now are the widest that they've been in quite some time, and that's very much a vacancy and speculative supply point.
And yields, do we think they're going to go down?
Absolutely. I think the fundamental change over the last 6 months has been the radical change in monetary policy. If you're a multi-asset class investor, you're looking at your go-forward returns from your bond portfolio, not terribly exciting. You may have benefited from the recent move in bond yields and have done very well, so the denominator effect is back again. With the cost of debt so cheap in Paris, especially for core product, to me that suggests both pressure on yields from the very low levels that they're already at and an even more competitive market.
Okay, good, great. Does anybody have a question that we haven't asked so far? Any topic that they wanted to pick up? I'm counting down backwards from 5 whilst I do this, just to give you a chance to. Good. Okay. Oh yes, sorry, Adam.
My name is Frank Agosto, and my question is: given that we had the longest economic cycle since 2019 up to now. Is there any reason that investors should be expecting or seeing a looming contraction within the real estate market?
Yeah, it will come from somewhere, but some are unexpected as usual. I think that's it's, the easy answer would be political. When you look at what's happening on the news, you're like, where the fuck I'm living, and when you look at the yields, you're like, well, on the other end, what's happening? It's going down. So, and well, with I would say 10-year back kind of mirror, you would say, it's impossible that the level of, well, just thinking about real estate deals, obviously, of the yield versus the political animosity that is going on, especially among Europe or in North America or in Asia too, is Middle East obviously is crazy. So if whatever Trump is going to do with Saudis versus Yemen and Iran, I don't know, or Italy is maybe a little bit better. We don't know what's going to come next in Germany. I don't know what's going to come next after October this year here. So, yeah, I would say that the easier answer is political, but at the end of the day, I don't have any answer to provide you. Obviously, but one thing what is really interesting when I was reading on Bloomberg a couple of weeks ago is they've been kind of screening and analyzing the real work of real estate managers on their asset. And basically, out of it, the conclusion was that only, I would say, 30% of the managers were really working the asset. So basically, tech upgrade, leasing, or improving the depth, or all the stuff we know well how to do. And the rest of it, no offense, and obviously I've been part of that too, just surfing on the wave. So I think as of now, as obviously maybe I join here the analysis, there will be a light compression, but as of now, if you act in the value add space, you need to take your shirt off and start getting a shovel or whatever, and building that asset, improving it, because no one is expecting easy, I would say, value. I think that would be the main difference for the next years to come. So you really need to work to get your profit, hopefully.
The good thing is we see a lot of investors still looking at this type of restructuring assets. We have seen a lot of files with investors taking assets to restructure and make value out of it. So that remains a good fundamental for the market.
Okay, good. Last question from me, 30 seconds each, so that we've got time for coffees and for people then to ask any questions that they wanted to as well in there. What does this all mean for investment? Where should people invest?
You said where?
Where? Where? Or in what? Yes. And I'm sticking to France for the purpose.
But again, I would say it depends on the strategy of the investor. I mean, clearly the allocation cannot be the same between one to the other. At the end of this panel, I think we can all confirm that the fundamentals are very strong, very good. So there's no class of assets that has to be escaped, I think, at least for the time being, and until our friends on the lending side will continue to sustain this trend. No, I think to be more serious, clearly there is I mean, the office market is very much booming. It's very difficult. The retail market, as Guillaume said, is somehow less readable than in the past because the malls are attacked, except the largest one. The high street is also in high demand, and probably the yields have been the lowest yields have been seen in the high street sector, actually on the Champs-Élysées or in the.
How much are they? Like 2?
It's sometimes below 2. Yeah.
On the case of
massive transaction. I mean the Apple store on the Champs-Élysées.
It's the case on logistics also.
And it's the same on industrial.
Are pretty low.
Yeah. So I would probably be more inclined to look at alternative classes of assets. I think student housing is an interesting one. Healthcare is an interesting one. And hospitality, as long as you can also manage the business, purchase and manage the business. I mean, if you have some expertise in the operations themselves, is also a very interesting class of asset in Paris because tourism is also in very high demand. So I would probably derive from typical portfolios such as office, retail, industrial, and probably investigate the other alternative classes of assets.
Yeah, I think there's been some concern that yields for a number of years might possibly go up. But actually, in the real world, that has not happened. What is happening is the demand is so strong in particularly Paris that if anything, quality properties the yields are still going down a little bit. So, you know, instead of moving up, they're actually moving down. And the other thing about the French market is that, as you said, there's been a reputation of France of being difficult for tax and so on. But I think you have to bear in mind that the present president and his policy is to stimulate that and get away from that view and put in place certain things like the OPCI movement and other things which actually will lower the tax rate. Yeah.
But it's really true what Paul mentions. I mean, the corporate income tax rate is being reduced.
Yeah. Gradually.
Yeah, gradually, but till 2020 it will be reduced to 25%. Whereas I mean we come from 34, so it's a massive reduction first. And second, it's clear and it's true to say that we have more stability and visibility on the tax regime and overall on the regulations. And it's thanks to the new government. And I think the trend is going to be confirmed in the coming years. There's clearly a willingness from the politicians to stop moving things all the time and create some, instability.
Okay, good. Where to invest, Andrew?
Yeah, 4 points for me. I think you can absolutely be comfortable taking letting risk in CBD Paris and fringe markets. As I mentioned earlier, target those fringe areas for catch-up rental growth potential, and I guess also reversionary potential, maybe more established areas of Paris. We're encouraging our investors to be open to investing in retail and actually making use of the less competitive landscape right now. Retail is being painted with one broad brush. We really like tourist and transport-oriented retail, and you may be able to access stock that previously you couldn't because it was more competitive. And then finally, take that long-term view on infrastructure. Look to Grand Paris, identify those areas that will have an enduring quality, and make that commitment now.
Great, Serge.
Yeah, I think CBD remains a very good area and with good fundamentals, and the depth of the market is there, so there is no issue with that. The only topic is how much are you ready to pay for that for investors. I would say that there is currently with all the momentum, the Grand Paris, or the projects around, I think that there are good opportunities around Paris in the first and second rim, and concentrating on good locations. There should be in the next 5 years, some good opportunities to make money.
Okay, great. Guillaume.
Yeah, I'm not going to repeat what has been said. So I joined the panel on CBD and Grand Paris. Maybe just two things. The thing is, I would say, is especially if you're if you have a type of strategy, please focus on this. So keep the discipline and do not go on a sector or on a philosophy that is not yours. So basically, if you're value add, if you try to do some core plus or core, it's not the same business. And maybe try to step a little bit out of the herd and try to get some or to understand how to approach some asset with potentially some more complexity that would kind of refrain other people to go into. So asset to where claims on it or administrative situation is not so clean, and well, it takes more time. You have to pay more lawyers, obviously. You have to be patient, but at the end, there's maybe you'll be probably better off than just queuing up on a tender offer where like 30 people are going to outbid you at ground, or 4 or 5, and at the end of the day, you're just going to be bleeding, and so discipline and try to potentially assess and get assets with more complexity on it.
Maybe a last one. Clearly, as a conclusion, what we've seen this morning is that there's a lack of good assets in general. So I would probably invest in a developer actually, because the developer at the moment are key in the chain of production process. So I would try to.
Do you have any suggestions?
I don't have a, but I think developers are really instrumental to the market.
Okay, great.